In this video, we will look at low interest loans as an example of taxable fringe benefits. The first example that we will be dealing with is as follows. An employee obtained a loan of 50,000 from his employer on the 1st of December 2021 to pay for a family holiday. The employer charged him interest of 2.5% per annum, and the employee had the option to use his credit card, but the interest would have been 5% per annum had they used their credit card. The employee repaid the full loan on the 1st of February 2022. So what we are required to do is to determine the value of the fringe benefit that will be included in the employee's gross income for the 2022 year of assessment. Right. So the amount that will be included for a low interest loan that will be included in gross income would be the difference between the official interest rate or the official rate of interest. Correctly said, that would be the official rate of interest less the interest that was paid by the employee times the value or the capital portion of the loan. Obviously, you will need to proportion that if the loan was not provided for the entire year of assessment. Right. So let's look at how we would go about that. So firstly, we need to determine what the official rate of interest is. Right. So the official interest rate of interest can be given in an assessment. So we can give you the official rate of interest, or we don't give it to you. What we would do then is we will give you or provide you with the repo rate. So that is the repurchase rate. Right? So if we provide you with the repurchase rate, you should be able to calculate the official rate of interest, and that is calculated as or determined as the repo rate, the repurchase rate, plus 1% or 1 point basis, which is equals to 1%. So if we give you the repo rate, for example, say of 7%, if you add 1% to that 7%, then your official rate of interest would be 8%. So if we give you the repo rate of 7% and you need to determine the official rate of interest, what you will do is add 1% to that 7 to get to an official rate of interest of 8%. So for the purpose of this example, we have given you a table of the official rate of interest since February 2016. So we'll just need to look at when the loan was provided, and according to the information provided, the loan was provided on the 1st of December 2021. And if we look at our table, we will then work with this rate over here. Right, so we will work with the 4.75%. Right. So once we do that, then we will need to compare that and look at the difference between that 4.75% and the 2.5%. So we will have our answer in the following way: the 4.75 minus the 2.5%. Remember, these rates are annual rates, multiplied by 50,000, which is the capital portion of the loan or the loan amount, right? Because the loan was provided during the year of assessment, then we will need to proportion that according to the number of days. Loan in all cases is apportioned according to the number of days and not months, right? So you are incorrect if you apportion it using months. The correct way of doing it is using days. Right. So you will get a final figure of 195 Rand, which will need to be included in the employee's gross income. The second example is similar to the first example, but the difference here now is the amount of the loan is not used for a family holiday, but it is used for paying school fees. So the employee uses that amount to pay for their own school fees. The question then is, what is the value of the fringe benefit that will be included in A's gross income? A is the same as the employee, in the previous example, right? So what will be included in the employee's gross income? And the answer to this question is based on what we have highlighted here, how the loan was used, right? So it was used to pay for school fees, and in that case then there will be nothing, a nil amount will be included in gross income because the loan was used to pay for fees. It is a study loan, and as a result it is a no value benefit for the employee, right? So the employee will have a no value benefit, and it will not impact their gross income, right? The third example is almost similar to example 1 and example 2. However, the difference in this case is that the value of the loan in this example is 3,000 as opposed to the 50,000 that we had there. And then we are back to the first scenario where the amount of the loan was used by the employee for a family holiday, right? So what is the gross value of the benefit that will be included in the taxpayer's gross income? And because the value is 3,000, the benefit, or this will result in a no value benefit, as the loan amount is less than 3,000. It's a short-term loan that has a capital value of less than 3,000. So therefore, as a result, it will be a no value benefit, meaning you will include 0 in the gross income of the taxpayer. Right. And then the last example that we have is as follows. You have B that rents a house from his employer from the 1st of March 2021, and he is given an option to acquire a house owned by the employer at a cost of 180,000. The rent expense is 500 rand per month, and it's based on 3.33% of the purchase price, being that 180,000. The house cost the employer 150,000. Assume the repurchase price has been 7% for the whole year of assessment. Right. So this brings me back to before I get there. Now, one mistake that most students do is they mostly confuse a scenario like this as a residential accommodation taxable fringe benefit, which is not the case, right? So this is a housing scheme where the employer provides their place to an employee at a rental that is cheaper, and then that would result in a deemed loan. So how do we calculate the benefit or the taxable benefit, if any? We will take the cost that the employee would buy this house at, which is that 180. The 180 over here, right? We take that and then multiply that by the official rate of interest. So how do we determine the official rate of interest again? Now, in this example, we don't have that official rate of interest, but we have the repo rate, which is 7%. For us to get to the official rate of interest, we will add 1% to that 7%, and we will have the official rate of interest of 8%. And this was this whole arrangement was ongoing for the whole year of assessment, hence the 365 over 365. And then from that, this would be the benefit less the consideration paid by the employee, that is that 500 times 12. That 500 is the rent expense that was paid by the employee. And then you get to a benefit of 8,400 that will be included in the gross income of the employee for the year of assessment. Another way of doing it is the 7% plus 1%, that official rate of interest of 8%, right, less the percentage that the rent amounts to. Remember, this 500 is based on the 3.33%, and then multiplied by the cost price to the employee, and you will get the same amount of 8,400, whichever way you want to do it. And remember, where you have this transaction or this scheme, it's not regarded as provision of residential accommodation. So you don't look at the number of houses, or the number, not the number of houses, the number of rooms, whether electricity is provided or not, it doesn't matter. So the essence of this transaction is a housing scheme, and therefore the way of calculating the taxable benefit is different from when you are provided residential accommodation as an employee. Right. And then this brings me to the end of this short video. I hope it was useful, and thank you very much.